Welcome to the Futures Financial Solutions channel. If this is your first time tuning in, thanks for stopping by. And if you're a returning guest, welcome back. We are a new channel focused on simply helping people see their future financial status from a different perspective. We share tips and insight on how to manage what you have and ways to earn more to achieve your financial goals. I know everyone has different specific goals. However, there are two goals most of us have in common, and they are eliminating unnecessary debt and finding simple ways to earn or gain more money. And in today's video, we talk about some important ways to grow your current income. In order to achieve this, you will need to implement these three things. The first is capitalizing on the net income you currently have. Next is managing your income through organization. And lastly, utilizing trusted methods to gain returns on your income. So first, we're going to look at capitalizing your income. The typical percentage one should save from their earned net income is 20%. Now, this is based on the premise of how we divide our expenses. And actually, this method was popularized by a famous book titled All Your Worth, Your Ultimate Lifetime Money Plan. If you haven't read this book, I do recommend you check it out. But if you haven't, it's okay. That's what we're here for. As a rule of thumb, your expenses should cover essential needs first, right? So what I mean by essential needs, that would include food, shelter, so that's rent or mortgage, utilities, and transportation. Once you cover your essential needs, then it's important for you to discipline yourself from unnecessary spending. Now, in my opinion, this is the key to managing your income and achieving your savings goals. This is something that it's a natural habit for a lot of people that they feel, hey, I work all these hours a week, I work hard, I want to treat myself to something. But when you have a specific goal at hand, whether it's saving or trying to boost the money that comes in currently, you've got to uh, implement some discipline in order to get there. Next, we're going to talk about organizing your income, and it's equally as important because it is the component that actually runs the engine, as that's kind of my analogy here for the methods or the tools that I will share with you today. So, if you are able to organize your money and how it's distributed, it makes the process more efficient or effortless. So, these are the two ways I feel that organizing your income can make things much easier. And that's setting up automatic deposits and auto draft payments. It can be a great foundation to achieving the following methods for maximizing your dollars. All right, so let's start talking about what happens or what you should be doing upon automating your deposits. You will need to designate them into appropriate categories or locations. For an example, a specific account you have designated for your essential expenses, whether it's a traditional bank account or HSA, which is also known as a health savings account. When you set up auto deposits in these types of accounts, it will ensure you will not waste um, specific money on non-essential things. If you have this particular account set up for my rent, my mortgage, my transportation, my car note, or what have you, you know that this is the money for those particular things and you won't touch it for those pairs of shoes or that briefcase or whatever it is that you may want that week or that month. So, uh, and the reason why I have HSA accounts on here is it's a great way to take a portion of your income before it even uh, comes outside your organization, right? Like it is, you designate at the beginning of the year or whenever your company actually does what they call, I'm getting a blank here. When you do your enrollment for your benefits. So whenever that time is throughout the year, usually it's like in October, like towards the end of the year, so that you're ready for the upcoming year, is that you designate a certain amount of money that you want to allocate to this account for the entire year. So you think about, hey, I need to buy some glasses, or I need to get some contact lenses, or I'm going to get some braces next year and I want to set aside some money for that. Uh, Whatever it is that you need from a health perspective, or my medication last year cost this amount, I'm expecting for it to get a little more expensive next year. So you allocate that money into that account so that you don't have to dip into the checking account or the savings account that is set aside for other categories of expenses. Make sense? Okay, so it just helps in avoiding overdrafts. And when you get overdrafts, then you have to deal with bank fees, and then that's another expense or money that's going out the door that doesn't need to go out the door if you're just to pre-plan in the beginning about allocating these categories for these particular bank accounts for these categories of expenses. So I always like to, for me personally, I have a set account, I have a set checking account for making payments for my rent and my utilities and transportation costs. So I know this account, I'm only using this account for those things. So when I need to spend some money on something else, I use a different account and I'm always able to cover my payments for my rent and for my utilities, right? I'm never concerned about overdrafting or not having enough money to pay for those things, right? And I think this makes more sense because these are the most predictable bills that you have or expenses that you have. Your rent, it should be the same every month, or your mortgage should be the same every month. If you have a car, your car note is the same every month. If you have auto insurance, it should be the same every month, if unless it's the last month of the of your policy period. If you're paying over the course of 6 months or whatever the case may be, then usually it's a little bit less. The point I'm making is when you have predictable expenditures, it's easy to allocate a specific account knowing that I need, just say for instance, $2,000 in this account so I can cover all those things. And any other money that goes into a different account, you know you use that for savings, investments, whatever the case. Right? And this brings us to auto drafts. So this is like the perfect companion to designating your essentials into a particular account. Auto drafts can help you avoid late payments, again, which can incur additional fees, as we were talking about with the overdrafts, as well as avoiding using your necessity money for something that you don't need or misappropriation of your funds. If you set up bill pay for your auto insurance and for your car notes, you always will be on time. Doesn't affect your credit because if you miss payments with your car note, that can affect your credit score. And now that they're utilizing RIP payments and utility payments to help boost credit scores, you want to maintain a, a normal on-time payment history for those as well. So, auto draft as a companion to auto deposits is a great way to stay on pace and stay on track of utilizing your money properly and efficiently. Okay. Other methods of using your or utilizing um, tools to maximize your dollars is through earning interest from a high yield interest savings account, which can be between 2 and 4%. Of course, they've got some savings accounts out here that's less than 2%. I know some of them are like 0.0 2% or what have you, but there are some competitive banks out here who are actually paying 2 to 4% interest on your savings accounts with no minimum deposit, no minimum balance, no monthly fees. So I just recommend you check with some your online banks that are out here. I know Capital One is one of them, and or check with your credit union if you have a relationship with your credit union. Find out what kind of interest rate savings account that they are offering their customers. Sometimes you can get a really good rate with your credit union. So I just recommend instead of having your money sit in an account where there is absolutely no benefit, it's just sitting there. Uh, Compared to putting your money, parking your money in a place where you can earn some kind of interest will increase or maximize the net income that you have coming in the door. The next item I want to focus on is investing in index or ETF funds. I feel it's a great way, and a lot of other people agree with me. It's a great way to earn an average of 6 to 8% conservatively from your initial investment. If you're utilizing this tool, it can really give you an edge on staying on pace with normal inflation increase rate. I know last year was out of bounds, totally off the chart, but under normal inflation rate increase, if you are investing in an index fund earning 6 to 8%, you you can do good with putting some money aside into that type of investment and don't feel like you are putting your money in such of a big risk compared to individual stock investment. And for those who are not as familiar with what an index fund is, it's a type of mutual fund, or ETF stands for exchange traded fund. What it is a portfolio of constructed um, accounts or companies to match or to track the components of the financial market index, right? So I'll give you an example. Standard & Poor's 500, or you may hear the short version, which is S&P 500, and that consists of the top 500 companies in the US. So they're all in this one portfolio. If you invest in this particular portfolio, you've got your money spread across all of these companies versus trying to find a winner. If you are not a professional broker, and if you do not have a broker, and if you don't have a financial advisor, it's best to utilize index funds or mutual funds to get the bang for your buck. And actually, index or mutual funds are said to provide a more broader market exposure. To your point, 500, to my point, 500 of the top companies in the US. It's a low operating expenses, so that means it's a low barrier of entry for you to invest in. And there's usually a very low portfolio turnover. So the people who create these portfolios kind of know what they're doing. And just so that you understand how it performs, these funds, they follow their own benchmark index, regardless of what's going on in the market or the state of the market. So we'll use 2022 as an example. If you invested in an index fund or ETF, and the market is going crazy, it's completely volatile, that mutual fund portfolio is performing at its designated benchmark index. Not not what's going on in the market, what you're seeing and you're hearing about on the news and all that. So you're still able to earn interest on your investment, even though the stock market is going crazy. So I personally consider this one of the safest ways to invest in the stock market, especially when you have limited knowledge and you have, a little bit of cash that you can set aside every month to put inside this portfolio and grow your investment. Now, I do want to say that if you want to get the best return of your investment, it is said that you should invest 5 to 15% of your income to get the optimum results. If you're totally serious about maximizing your dollars, take at least 5% of your income that you can afford. And as time progresses and you're able to put more in there, operate between 5 and 15% of your income. And this actually can be done via a 401k. I know that's becoming obsolete, but some companies are still offering that platform. If you don't have access to that, you can use other platforms out here like Webull, Stash, Robinhood, Acorn. They are all become quite competitive with each other. So choose the one that best suits you, the platform that's is user friendly, easy to understand, and has a good support uh, system, meaning that if you have questions, you can easily get help through their platform. And finally, I want to talk about debt elimination or payoff. This is super important. If you are like most people, you've got some debt that you need to take care of. And especially a lot of us have credit card debt. That includes me. And it is advisable that you utilize some of your income to pay off or pay down your credit card debt consistently. I say consistently or put emphasis on consistently because if we do something with the intent to get down to zero, you have to do it consistently. I know things come up in life and you have to use your credit card for an emergency or whatever the case may be. But if you have a consistent, disciplined behavior to pay down and pay off your credit card bills, it will be you will be rewarded. I'll just say that because if you are utilizing less of your credit score will increase. You'll feel less angst and less stressful. You've got some cushion there. If you do want to use your credit card to maybe earn rewards or what have you, you're not hitting the ceiling of your credit limit. It's just it's an all around good plan to dedicate your efforts and your energy and a portion of your income to pay off your credit cards or get it down to a minimum amount so that you have that money available. Uh, I won't start talking about credit card arbitrage, but it just makes sense to pay down your credit card bills as quickly as you can. And so, in doing so, I want to talk about two different methods of doing that, and that's snowball and avalanche. Now, these are two well-known methods. Uh, the main difference between the two is that the snowball starts with the smallest debt and then you make your way to your largest debt. So, for instance, if you got a credit card that you only owe $1,000 on, uh, pay that one first. And then you got a personal loan, it's about 5,000, pay that one next. You've got another credit card bill that's 10,000, you pay that one next. You see, it's a small ball, small to the next and then to the largest. And for me, I think utilizing this method is a morale booster. As you see your debt disappear, the smallest bill is more attainable in the beginning. This is a new process for you. Once you see that bill's paid off, you're like, hey, I'm doing something right here. I was successfully paid this bill down to zero balance, or I paid this bill off. I paid this debt off. I feel good. Let me keep going. It just will encourage you to continue on with the process. Now, the difference with the avalanche approach is that you're tackling the largest debt first, or the debt that has the highest interest rate. So we'll go back to the credit card example. You may have a credit card that's at 24% interest, and you may have another one that is like at 19%. In the avalanche approach, you're going to hit that credit card that has the 25% interest because there's more money going out the door and you want to stop bleeding that cash as soon as possible. So you're going to tackle this particular credit card first, get that down to zero, and then you make your way to the next large bill. Could be your car notes or mortgage or whatever you find to be a bill that is nagging you the most and you really want to get rid of it, or you really want to get it down to a level where you're feeling more comfortable and that you can breathe. So that's the avalanche, whereas the biggest one goes first and the smallest one goes last. Okay? So I just want to say that no matter which approach you take, everybody's different. Just be clear. Make sure that you clear out your essential expenses first. Take care of your rent, your food, your transportation, your utilities. Make sure that's all clear. Then you start to make your way to paying off your debt consistently. I do also want to remind you that when you are making a conscious effort or decision to invest your money, be certain that you are aware that you are entering a process or utilizing your money, utilizing a way to grow your money with associated risk. Understand what your risk tolerance is, work with that tolerance until you're able to get to the next level. For an example, there are different risk tolerance. Hey, I want to play it safe. I'm not going to put too much money here. I want to see how this works. I want to see how my return of investment looks. All right, this looks good. Then I move on to the next or the moderate level of risk. So just be aware of what your risk tolerance are. Accept those tolerance and understand that if you cannot afford to lose this money or a portion of this money, do not invest until you are at a financially comfortable level. I always like to give that disclaimer because we're looking to make your financial situation better, not worse. Okay? Now, managing your money and maximizing your income doesn't have to be difficult from my perspective, hence why I'm doing this video. If you take these simple steps, you can see the difference in your financial position. It it's never a bad time to start or to change or to improve. I always say sooner is always better because it ensures you will experience faster results, right? Remember, the longer you wait, the longer it's going to take for you to reach your goal. So just jump in there, prepare yourself mentally, be prepared to be disciplined, stay on track. Sometimes life happens and it may throw us off a little bit, but get back on track and continue on until you reach your goal. If you found value in today's content, you learned something or you think someone you know can learn from this video, I encourage you to share it, like it, and put a comment down in the comment section. I also want to invite you to subscribe to get regular weekly updates. Like I mentioned before, this is a new channel, so we welcome all kinds of feedback. Be nice. If it's not nice, be constructive. Constructive feedback is necessary so that we can improve, whether it's the content, our delivery method, or whatever the case is. I want to say thanks again for sharing your time with me today and with your commitment to seeing things a little bit different than you did yesterday. Change is absolutely necessary, and growth comes from investment. So I encourage you to take a chance on yourself and invest in your future. Someone in your family is counting on you to lead them to a new experience and an elevated way of thinking. Until next time, envision your future on another level and embrace the solution that will get you there. Have a great day.